What's going on YouTube? Welcome to Currency Counts, where I cover all things money. In today's video, I'm going to cover all the boxes you need to check in order to purchase your next home. You're going to want to watch the entire video because every step is important. Let's get right into it. All right, so before we begin, I just want to do a quick PSA. I've been going through my comment section and I noticed there's somebody out there or multiple people, a bot, something, claiming to be Currency Counts. What these people are doing is they'll go through my comments. If somebody's asking me a question, this channel or this person, this bot is going and saying, hey, I can answer your question, I can help you. YouTube doesn't let me contact you through the comment section for whatever reason. Email me at this email address. What they're trying to do is get your personal information. I will never ask you to email me outside of YouTube or contact me outside of the YouTube comment section. The first question a lot of people ask is, what credit score do I need to qualify? Depending on your lender and the loan you apply for, you can qualify with as little as a 580 credit score. For better terms, you're going to want to be above a 620. But it's more than just your credit score number, it's what's in your credit report. For example, if you have collections, no matter your credit score, you're going to need to clear those up before you're approved. Other credit factors come into play as well. You can go to tomorrowhometoday.com if you want some more information about your specific situation, or if you're ready to take the next step to home ownership. Next is down payment. How much are you going to need to put down on a house? This goes back to the type of loan you apply for. For a FHA, it's 3.5%. So on a $250,000 loan, your down payment is going to be $8,750. Not bad, right? Under 10 grand for a $250,000 loan. But the one thing that's often overlooked when taking out an FHA loan is the dreaded PMI, private mortgage insurance. PMI is added on top of your mortgage payment and can be anywhere from $150 to $200 every month. And guess what? That doesn't go towards your loan principal. It goes to your lender as insurance in case you default and get foreclosed on. But PMI will automatically be removed once you reach 78% of your original loan principal. So in a sense, you're putting 20% down because that's what you're going to be paying anyway. But unlike putting 20% down on the front of your loan that's going towards a principal, the 16.5% give or take you pay to PMI is going towards your lender and it's not going towards your principal. So you have nothing to show for it. For a conventional loan, you can put as little as 3% down, but you're going to need a good credit score. And you're also going to need to know what loan to apply for. And if you served in the military, you might be able to qualify for a VA loan if you meet certain requirements. And with the VA loan, you can qualify with 0% down, but there is a 2.3% funding fee, which is more or less like an origination fee, the cost of borrowing money. So 0% down sounds good, but a 2.3% funding fee, which is money down the drain, you're not seeing anything from that. Or add another 0.7% and you're at a 3% with a conventional loan that's actually going towards your principal, or 3.5% with a FHA that's also going towards your principal. These are the things you're gonna need to know and consider when applying for a home mortgage. Next is your debt to income. Now this is going to entirely depend on your lender of where you need to be at with your debt to income ratio. But a good rule of thumb is to keep your front end debt to income under 36%. I should have a video linked right here somewhere of how you can calculate your debt to income ratio. And don't get credit usage confused with debt to income. Credit usage isn't as big a factor when trying to get approved for a loan, unless you're trying to improve your credit to get a lower rate. Don't get me wrong, some lenders will require you to lower your credit usage to a certain percentage. It just depends on your credit situation. Lastly, how much money do you need to make per year to qualify? This is a tricky one. I also have another video linked right here somewhere of how much home you can afford making $10 an hour. When you think of a home loan, think of it as a car engine where you need all the parts in the engine in order for it to run correctly, not just the motor. In this case, your annual income being the motor, a very crucial and vital part in determining how much you qualify for. Let's do an example here. You make $62,000 a year and your debt to income is 15% and you have a $15,000 down payment, a credit score of 620 and an interest rate of 4.5. You might qualify for a loan of $165,000, but the house you want costs $240,000. How do you get it? If you do this one thing, you're gonna see a major difference. If you bring down your debt to income from 15% down to 5%, your pre-qual amount is now gonna be $231. This is just a generalization and it goes back to what your lender requires. But there are ways to getting you approved for the bracket of home you want. You're just gonna have to be willing to work at it. So I'll leave you with this, an easy estimate when looking at home prices and how much you can afford. For every $100,000 you borrow, expect to pay about $1,000 a month. So if you're looking at a $300,000 house, expect to pay about $3,000 a month, give or take. And that's for your principal, your interest, property taxes, and homeowner's insurance. This is just a generalized estimate, but just to give you an idea of what you're gonna be paying per month for your mortgage. I hope this video helped you out. Subscribe and get notified. Check you on the next one.